Have you ever felt pressured by a sudden phone call from someone trying to sell you a financial plan? To protect you, there are strict rules for how companies can reach out. Sales agents are only allowed to call you between 9 in the morning and 8 in the evening, unless you have specifically asked for a different time. When they call, they must immediately tell you who they are, which company they represent, and why they are calling. They must be professional and are never allowed to use high pressure tactics or make false promises about how much money you will make. Building on that idea of honest communication, let's talk about the red flags you should watch out for. You should be very careful. If someone promises you high returns that are supposedly risk-free. In the world of finance, every investment carries some level of risk, and higher returns almost always mean higher risks. If a deal sounds too good to be true, it probably is. You should also ensure that your investment advisor is acting in your best interest. Make it a habit to review your account statements every month and conduct a full review of your plans at least once a year. Now that we understand the importance of watching our advisors, we should also be aware of a practice called churning. This happens when a broker makes many unnecessary trades in your account just so they can earn more commission. If you see an unusually high number of trades in your monthly statement, you should investigate it immediately. Similarly, when attending investor seminars, avoid making rushed decisions. It is always a good idea to get a second opinion from a neutral third party before you commit your hard-earned money. Moving forward, a good advisor will always start by understanding your personal risk profile. Risk is not just about losing your money, but also the chance that you might not get the return you are hoping for. Your ability to take risks depends on many factors, such as your age, your income, and how many people depend on you financially. For example, a young professional with no children can usually take more risks than a senior citizen who is living on a fixed income. A long-term investment plan generally allows you to handle more ups and downs in the market. Now that we have identified how risk is measured, let's look at the document that explains it all, the risk disclosure document, RDD. Your broker is required to give you this document, and make sure you understand it before you start trading. It explains that while stocks often do well over many years, they can show a loss in the short term. This document is especially important for complex products like derivatives, where the risks are much higher because of leverage. Leverage means you can control a large amount of stock with only a small amount of money, which can lead to big profits but also very big losses. Building on the concept of risk, there are three main types you should know. First is market risk, which is simply the chance that stock prices will move in a direction that causes you a loss. Second is liquidity risk, which happens when you cannot sell your investment quickly because no one is buying at that moment. Finally, there is counterparty risk, which is the danger that the other person in the deal will not fulfill their promise Luckily, for trades done on a recognized exchange, SEBI and the clearing corporations guarantee that the deals will be settled, which helps reduce this worry. To understand why these warnings are so serious, we should look at a study conducted by SEBI. Their data shows that 9 out of 10 individual traders in the futures and options segment actually incurred net losses. On average, these traders saw a loss of 50,000 rupees. To make matters worse, those who lost money spent an additional 28% of their losses just on transaction costs. This is why brokers are now required to show these facts clearly on their websites and keep records of their clients' profits and losses for at least 5 years. While we focus on protecting your money, the law also focuses on keeping the entire system clean through the Prevention of Money Laundering Act or PMLA of 2002. This law is designed to stop people from using the financial market to hide money made from crimes. Every broker must have a written plan to check their customers, which we call customer due diligence or CDD. This involves verifying who you are using reliable documents and making sure they know where your investment money is coming from. Now that we understand the legal background, let's look at what you need to open an account. For an individual, a PAN card is absolutely mandatory. You will also need to provide proof of your identity, like an Aadhaar card, a passport, or a driving license. For your address, you can use utility bills like your telephone or electricity bill. If you are opening an account for a company or a partnership firm, the requirements are more detailed and include things like a certificate of incorporation or a partnership deed. In today's digital world, this entire process can be done online through e-KYC. You fill out online form, upload scanned copies of your documents, and complete an in-person verification through a video call. Once finished, you are given a unique client code or UCC, which is linked to your PAN card. SEBI has also made sure that this process is accessible for persons with disabilities. For instance, a judgment on April 30th, 2025 stated that if a blind investor cannot perform the standard eye blink test for proof of life, they can use other signs like nodding or showing an OTP on screen. Even with the best systems, suspicious activities can happen, and they must be reported to the Financial Intelligence Unit of India or FIU-IND. Some examples of things that trigger a report include a client refusing to cooperate with identity checks or sudden unexplained increases in a person's trading volume. If a broker suspects something is wrong, they must tell their internal control officer immediately. However, they are not allowed to tell the client about the suspicion and must continue to act as if everything is normal unless they are told to stop. But what if you are the one with a complaint? This is where the grievance redressal mechanism comes in. If you have an issue like a broker not returning your margin money or executing a trade without your permission, your first step is to complain directly to the exchange in writing. There is no fee for this. If you are not happy with their answer, you can move to the next level by using scores, which is the web-based system from SEBI. The company involved must then look into your problem and upload a report showing what action they took within 21 days. Building on that, we now have a very modern tool called the SMART ODR portal. This is a digital platform that helps resolve disputes through conciliation or arbitration. First, a neutral person tries to help both sides reach a friendly agreement within 21 days. If that does not work, the case goes to an arbitrator who makes a final binding decision. If the arbitrator decides you are owed money, the other party usually has to pay you within 15 days. This digital first approach makes solving problems much faster and easier than it used to be. To wrap everything up, let's remember the basic do's and don'ts for every investor. Always deal with intermediaries who are registered with SEBI or the stock exchanges. Read every document carefully, especially the risk disclosure, and always keep copies of everything you sign. Most importantly, never make any payments in cash and never follow tips or rumors blindly. By staying informed and following these simple rules, you can protect yourself and your investments as you navigate the Indian financial markets.